Hello, welcome to Anu's classroom. In this video, we'll be talking about unit number 10 of MMPC 3, that is business environment. So, the international financial system, what is it? It is a combination of financial systems of both individual countries in the world as well as monetary agreements like our European Money Union and all, and the operations of organizations like World Bank or IMF, the exchange rate systems that are followed by the individual countries and things like that. And when we talk about this exchange rate system, then most often it is taken, USA is taken as the anchor country. So the major role of this international financial system, why do we need this international financial system? It is to maintain stability throughout the world, right? So with that in mind, in this session, which covers unit 10, let us try to make what you can say a humble attempt to understand how this international financial system works. What are the institutions which are responsible for stabilizing as well as reconstructing the countries in the world globally who need assistance, financial assistance? Then there is something called as the Bretton Woods institution. So what are the roles and functions of this Bretton Woods institutions? What is the difference between the International Monetary Fund, that is IMF, and World Bank? These are two words I'm sure you must have heard time and again, right? Any country which is in financial crisis, you will definitely hear these two words, right? International Monetary Fund and World Bank. So what are the functions of IMF and the World Bank, and how these two institutions are different also, we will learn in this unit, in this video. So coming to the International Monetary Fund, let us start with that, which is one of the important topics itself. Multiple times this has been asked in our exams also. So the International Monetary Fund, or IMF, is an international organization which promotes global economic growth as well as financial stability, encourages international trade in attempt on reducing poverty, which is a kind of a debatable topic, to be honest. So IMF is actually based in Washington DC and is currently composed of 190 member countries. Each of these member countries has a representation in IMF executive board in proportion to its financial importance. So if so take for example a country like USA will have a higher importance and a higher representation in IMF's executive board than some other country. So the IMF's website, if you go and check, it describes its mission as to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. The IMF was actually originally created in the 1945 as part of this Bretton Woods Agreement, which attempted to encourage international financial cooperation by introducing a system of convertible currencies at a fixed exchange rate. And the dollar was at that time redeemable for gold at $35 per ounce. When is this? In 1945 we are talking about, at the time when this IMF was created. And since the Bretton Woods system, there is something called as the Bretton Woods system, it collapsed in 1970s, and the IMF has promoted the system of floating exchange rates since then. So what is floating exchange rate? It means that the market forces will determine the value of currencies relative to one another. Okay, and this system of floating exchange rates is what remains in place today. If you guys know, earlier, maybe in our childhood and all, you might have heard that all our currency values and everything was treated with in what you can say based on the gold reserve that we used to have. So those kind of things came up during the Bretton Woods system. Now it is all gone. And so you might be wondering where this IMF actually gets its money, correct? So how IMF gets its money is through quotas and subscriptions from the member countries. You remember there are 190 member countries. So these contributions through quotas and subscriptions and all are based on the size of the country's economy. So that is why US which is the world's largest economy, is definitely the world's largest contributor, so has the highest say in all matters of IMF. Okay, so the key objectives of IMF, what are they? Number one, to promote cooperation among the members in monetary matters and provide a forum for discussion so as to maintain cordial relationships. to smoothen the process so that international trade is fostered, employment levels increase, real income grows, and productive resources will accumulate for the member countries. To incentivize orderly exchange rates, agreements, and its stability, see to that the member countries don't indulge in competitive devaluation and things like that. And to help the member countries develop a system of payments so as to facilitate multilateral transactions and remove any kind of restrictions on foreign exchange which will hamper trade, and to become a vehicle through which members can get over the difficult times in terms of any problems with the payment and things like that, by accessing the resources of IMF so that they don't have to resort to policies which are further damaging, and to lessen the trauma of the member countries by shortening the time and degree of disequilibrium in balance of payments, BOP. So in case you guys are wondering what balance of payments is, it is the next unit in our course, that is unit number 11. We will come to that in the next video. Okay, we'll take deep in depth, we will discuss about what this balance of payments is and why it is important and why is it taken care of so much and all those things. So the IMF performs the following functions, you can say, in which, and it these functions, they range from surveillance of the member countries to the to being an advisory for mobilizing external finance also. So number one is that IMF has the mandate and legal backing to monitor the economies of the member countries to check whether they are conforming to its objectives. Then, another major function of IMF is direct lending to member countries to get over with their temporary balance of payment difficulties and to see to it that they take corrective measures so that the disequilibrium in balance of payments will get adjusted smoothly. Low-income countries are helped by IMF through linking them to external donor agencies and sources of funds. Along with World Bank, IMF also helps such countries in their payments and development spheres. IMF is also involved with debt relief and high indebtedness of these countries. IMF constantly monitors the member countries' economic well-being also, and it helps donors and financial markets to properly gauge the economies. And what happens is that this helps them to get external funding. These member countries who are needing finance, it helps them to get the external funding from donors and things like that. The institution also serves as a forum for consultations and international coordination among member countries so as to prevent disorderly movements in exchange rates. Why exchange rate is important? Because it is the floating exchange rate which determines the value of each and every country's currency, correct? So the supply and also IMF helps in supplying additional international liquidity through issuing special drawing rights, that is SDRs, if the need is felt. What are SDRs? SDRs are a unit of accounting in which fund transacts with its members, but they are not a claim on the institution. Okay, SDRs can be exchanged for convertible currencies. They are, you can think of it as commercial paper, a kind of commercial paper. So you can purchase SDRs from IMF, but that doesn't mean that you have any additional claim on IMF. Okay, so that is what SDRs are. Maybe they can be later reclaimed for that face value amount. That is what can be done. So IMF also engages in training and capacity building of especially developing country members in areas of its expertise. This helps the members to avoid costly mistakes while formulating their economic policies. So IMF actually meddles with the economic policies of its member countries if the member countries are in financial trouble. In order to serve its members in a better way, the fund, that is IMF, undertakes research in areas where it normally advises. The research is disseminated through reports, working papers, journal articles, and all through electronic modes. It is also a major source of cross-country data on financial, monetary, and economic variables that are useful to its member governments and researchers and business people. Why? Because every country doing this research could be costly on them. So the other countries can use the IMF data as a secondary data source and do their analysis on it. Okay. So the IMF's role in any member country, it mainly starts when they are on the verge of defaulting on their external obligations like imports or external debt servicing. Okay. So that is when IMF actually comes into play in any particular economy. If there is no issue in repaying their debts or paying for their imports or anything, IMF will not interfere in that country's economy. But if there is a default, or if they think that there is going to be a default, the country cannot manage, then definitely if you are a member country of IMF, then they will get involved. So IMF, when they get involved, they decide on the modalities of help, which majorly are soft loans, which are proportional to the country's quota. Okay, so the repayment schedule is decided on the basis of the liquidity condition of that particular country, so that they don't face any particular problem. And in lieu of the help the countries are given from IMF, they have to follow IMF's conditions. And such conditions are mainly targeted towards bringing the country back to the growth path. The reason why they had to seek help from IMF itself is because they were in some kind of a trouble, right? Their economy was not in a good shape. That is why they were not able to repay, right? So IMF will keep forward certain conditions. They'll say, do this, do this, do this, and the country has to oblige, then only they'll get help. So typically, the policies which they suggest are policies to improve their budgets, reduce inflation, privatization, liberalization, and things like that, which are basically market-oriented policies. But IMF cannot force the countries to follow these conditionalities, but they can definitely withhold any further assistance, or they can delay the subsequent sanction of loans to those countries. So you might have heard many favoring as well as criticizing comments about IMF in the news. Whenever a country is in debt, financial crisis, definitely, as we said earlier also, there will be IMF coming into picture. So how about what you can say, the major debate or the major headline which comes up is about how IMF has made the country has put the country in a worse situation than what they were earlier in. And some thinkers, such thinkers, they feel about how if IMF had not interfered, the country would have been much better off than what has happened to the countries because IMF has gotten involved, right? Some thinkers also don't feel that way. Some thinkers definitely think that because IMF involved in a timely manner, they helped the nation, and that is the reason why that nation is at least where they are right now. Otherwise they would have gone into a much further deeper pit. Both sides of the coin are there. So what I want you to do is, in case you guys get time, I want you guys to do a very small activity. Go online, search for a few cases where IMF was involved in any country of your choice, okay, and understand what they did, and comment your thoughts on what you feel has happened to the country post this involvement of IMF. Okay, so in case a question does come about IMF, definitely such an exercise, such an example would help you in your term and examinations also to provide that example. You can quote that example and talk about your views also, or you can quote that example to say how IMF has helped. Things like that can also be done. So it is a very good exercise in terms of your term and examination as well. Won't take much time, just maybe 5 or 10 minutes you spare on this. Just do a quick search. Okay, you will gain much more insights on what is happening with these things. Okay, yeah, so that is about IMF. Now let us talk about World Bank. So the World Bank came into being after this Bretton Woods conference, and the major role perceived for this institution was to rebuild the countries that were severely impacted by the World War II. It functions like you can say a development financial institution and an investment bank at the same time. And after its operations in the war-ravaged countries, we could see that their countries' conditions improved, and the bank then shifted its focus to development needs of these poor countries. The funding source for the bank's operation is mainly the capital markets, and they issue bonds and grants received from its members, and other sources are the major sources of funding. Direct selling of bonds and notes to its member countries are also sometimes resorted to raise funds. So unlike the IMF, which had its quotas and subscriptions and all, a World Bank does its source of funding mainly by selling bonds and notes. So, what are the roles of World Bank? Some of the roles of the World Bank are to assist the countries to come out of their indebtedness. Poverty reduction, which is like a thrust area for the bank, has led to major loans to poverty-afflicted countries over the years. Country assistance to identify projects which require the assistance of the bank. It is a provider of international public goods, and given its expertise in a wide-ranging area, the World Bank is also a repository of information which spans across countries and sectors. The bank needs research to decide whether its intervention strategy is required and what kind of intervention strategy is required in case it has to intervene, and to monitor the countries to identify about any early warning signs that the country is going into debt and things like that. Based on the research, this bank can provide relevant advice to its member countries. The databases that are hosted by the bank can also be used by academicians, policymakers, corporates, people like us also who are doing any kind of projects. If it is relevant to us, we can also use it for their relevant work. So it also functions, the World Bank also functions like a knowledge bank. Now, under the World Bank, there are a few institutions. Let us look at a few of these World Bank institutions. So, IGNO expects us to know about the International Development Association, that is IDA, International Finance Corporation, IFC, Multilateral Investment Guarantee Agency, MIGA, International Center for Settlement of Investment Disputes, ICSID. So, these are the four major institutions which come under the World Bank, which are focused by IGNO. So we need to know at least something about these institutions in case the question comes purely about World Bank. At least these four names you guys must by heart. Okay. So the International Development Association, that is IDA, is the arm of World Bank which looks after poverty alleviation and debt relief of majorly the 74 poorest countries of the world. So what they do is they lend money on concessional, or you can say near zero interest rate terms, and these loans are made for long term like 30 to 40 years and all, with interim 5 to 10 year grace periods also. The debt relief is done through two initiatives called Heavily Indebted Poor Countries and Multilateral Debt Relief Initiative. So the institution provides a range of assistance to promote the economic growth, equality, employment opportunities, higher income and enhanced living standards of these countries. And the major areas that are covered under the institute's initiatives are primary education, basic health services, clean water, sanitation, agriculture, business climate improvements, infrastructure and institutional reforms. Then comes the International Finance Corporation, or IFC. It is involved in the private sector development in member countries, especially those projects which have welfare implications. The institution can help private sector entities by giving them loans, taking equity stakes, stock options, or even by sharing profits. It may provide venture capital and simulate investments by other private entities, and overall they try to develop the capital market in developing countries. Coming to the foreign investments, they are an important source of funds for fueling the economic growth and reducing poverty in these developing countries. So, MIGA, that is Multilateral Investment Guarantee Agency, they try to channelize this foreign investment in disturbed and poor countries through its initiatives. The most important of them is the political risk insurance products, which can be bought by these investing companies to guard them against any problems which make their investment bad in host countries. And this agency also provides services like technical assistance to promote investment climate, settle investment disputes, and promote foreign capital flows in distributed countries who need them the most. This ICSID, that is the last institution that we have to learn out of the four. It gives a platform for these investors to settle their disputes with the host states. The members involved in the dispute can voluntarily resort to the mechanisms that are available with ICSID to settle their disputes. But the main important thing that we have to note there is, once the help of ICSID is sought, these countries cannot withdraw from the proceedings. ICSID will provide well-equipped hearing rooms for the proceedings related to these disputes. So that is about World Bank. Now, if we are to summarize the difference between IMF and World Bank in just one sentence, we can say that the IMF is primarily focused on stability of the global monetary system and monitoring the currencies of the world. Whereas the main aim of World Bank is to reduce poverty across the world and strengthen the low to middle class populations. But if the question comes for 20 marks, this is hardly enough to get marks, right? So I took the liberty of copy pasting what is given in your course material in MMPC 3, which details the difference between IMF and World Bank. Okay, so you have to learn this difference. Okay, this is directly from your copy only, MMPC 3 only. I've just copy pasted it on the screen. So this will be there in your course book. If the question is asked for your term and examination, asking you for what is the difference between World Bank and IMF, give a brief about what is World Bank, what is IMF, what are its various functions, whatever you can remember, at least 2 or 3 points, and you can give this one liner difference between this World Bank and IMF, which we just discussed. And after that, you can you can write down this tabular form. You can write down the difference between this International Monetary Fund and World Bank, which will be enough for 20 marks. So so that is how I would suggest you, in case this question comes for 20 marks, you can answer. But if it comes as part of a short note, okay, one of the short note questions, then it is more than enough that you draw this. Definitely, yeah. Just give a one-liner about what is IMF and what is World Bank, and then you can draw this box. It should be good enough for a short note question, because most often, at least it will be like at least three options out of 5 and all will be asked for short notes, right? So approximately it will come around like 20 marks, right? So 7 marks around only it will come. So this is more than enough. Okay, so this is how you can target for your term and examination in case this question comes. Now we will also see about, we'll talk a little bit about the international monetary system. And at the international level, nations transact with each other mainly through their trade and capital flows. And the net transaction has to be settled at regular intervals. While engaging in such transactions, some of the countries may face situations where payment obligations are more than their receipts. And in such cases, what will happen is, we say there is a disequilibrium in the balance of payments, that is BOP. Okay, it is either met through foreign exchange reserves or through borrowed funds. This BOP disequilibrium, how it will be rectified is either through foreign exchange reserves or through borrowed funds. So there is a requirement for countries and institutions to act as a supplier for such reserves, definitely. And the amount of such reserves that would be demanded would depend upon the speed of adjustment of BOP and the institutional framework of this world economy. The exchange rate system which are followed by countries also will impact the amount of reserves which can be demanded. So in a completely market determined exchange rate system, okay, like the floating rate exchange rate system, the movement in exchange rate will bring the BOP back to equilibrium, which will reduce the requirement for international reserves. So in case of a fixed or pegged exchange rate system, in order to maintain a certain level of exchange rate, what will happen is the requirement of foreign exchange reserve will increase. The other function of international reserve is to facilitate government intervention in foreign exchange rate markets. Higher the volume of such activities, higher the requirement also for international reserves. The other major factors which impact the demand for this international reserve is the speed of automatic adjustment. Policies that are aimed at restoring the BOP equilibrium and international coordination of economic policies and all. If the economic adjustment mechanism takes time, then demand for international reserves will also go up. The supply of international reserves can be owned or it can be borrowed. They are majorly in the form of gold, acceptable foreign currencies, or special drawing rights, STRs. Where is STRs coming from? From IMF. Okay. Gold has always been a major form in which the international reserves were kept during the year of the gold standard system, which is from 1880 to 1914. Gold served as a means of payment. That is where the Bretton Woods system was there. It got disrupted during this 1914 period only. The unit of account and store value was gold at that time. The international currencies were denominated in terms of gold, and since its supply was not flexible, it disciplined the central banks also, in the sense that excessive money growth was not possible. Countries stood committed to the exchange to exchange gold for their currencies also freely. The importance of gold in money supply, however, drastically came down before the World War I, and the importance of paper money and demand deposits in banks increased manifold. When the World War II came, after the World War II, IMF came into being. World moved on to what is known as the gold exchange standard. Gold was considered as the unit of account. US actually took the responsibility of being the international banker. Dollar was denominated in terms of gold, and all other currencies were denominated in terms of gold or gold content of this dollar, and US agreed to freely convert their dollars to gold whenever it was presented with the currency by other countries. And so what happened? Dollar served as the reserve currency for almost many of the nations of the world, and this system was also very perfect till US gold reserves were higher than the outstanding dollar liabilities. Any guesses how that could have happened? Any guesses how that could have happened? Fake currency, right? That is how, right? More currency, US dollars, came into circulation than what the US actually printed and gave out, right? So that is when this issue happened. So US gold reserves were higher than the outstanding dollar liabilities. So gold reserves fell short of such liabilities. What happened? Fear crept into the mind of countries holding this US dollar, that US might have to devalue the dollar. So now what will happen? If the US devalues the dollar, they have all gold, they have all dollars. Now whatever, like for example 100 USD they had, if US devalued the dollar, it will be worth much less. So they will it will be a loss for the countries which are holding this US dollar with them, right? So on 1st of January 1975, gold was abolished as the unit of account, and it could be freely traded by countries like any other commodity. And so the use of gold was also discontinued by IMF as well. That is when you can say that it was President Nixon at that time who said that US can no longer exchange the dollars with gold and things like that. So given the expansion of this international trade and capital flow, dollars and gold was found to be inadequate to serve as the international reserve, and therefore a need was felt for an additional international reserve currency. That is when STRs were contemplated as a unit to decide the contributions of the members to IMF. The nations can access this international reserve from two special windows of IMF. One is the IMF drawing. In this, nations will in need of international reserve can buy foreign currency by pledging their home currency and agree to buy them back at a future date. This is normally extended till 50% of the quota for that country is reached. Additional amounts can be accessed through special permissions. And the second option is to access credit through IMF's general agreements to borrow. G10 countries have agreed to give this additional funds to IMF to finance this facility. This is over and above the amount which is accessed through this IMF drawings using their quota, when the latter is found to be inadequate to finance this BOP deficits. So mainly from this unit before is IMF and World Bank. Okay. So before we wind up, I have a very small request to those of you who have come this far in this video. I want you to ask Google or say ChatGPT about the time India faced a BOP crisis and discuss about the same in the comment section. It will help our community members in creating an understanding of what has happened in our nation also. So I hope this session and this video, this course is providing useful to you in the preparation for your exams. I know it is right around the corner here. Until I see you in the next session, take care. Thank you so much. All the very best for your term and examination. Bye-bye.